Ben, catch us up on whether we're moving forward with a shutdown, Ben, and what we need to know.
Yeah, Josh. The short answer to your question of whether we're moving forward appears to be no. We've had a day here in Washington that's a whole lot of name calling and very little apparent progress, with a shutdown now about 9 hours away. As John Thune, the Senate Majority Leader, said just about an hour ago, there's nothing left to negotiate from his perspective there. That's because the Senate plan is for a series of votes starting at about 5 p.m. tonight that are essentially a rehash of previous votes, one Democratic plan, one GOP plan, both of which have failed previously. And the widespread expectation here is that both will fail again to reach the 60-vote threshold that would avert a government shutdown. After that, they're kind of out of options at this point for a shutdown, which would begin at 12 o'clock. President Trump earlier today called this shutdown likely. He also signaled plans that as he's been doing for days now, of sort of taking advantage of this shutdown to implement bigger cuts than we've seen in previous shutdowns. So that could increase the effects. He talked about, as a way to do political pressure, cutting programs that Democrats like. It's clearly to pressure them to concede. The question is how far he goes forward if we're in a shutdown situation tomorrow. Either way, we're having a lot of effects that we'll likely see if this shutdown goes forward, starting with furloughed workers, but looking ahead to the jobs report Friday, which will be delayed if this shutdown does proceed in a couple hours' time.
All right. Thank you, Ben. Appreciate it. Stocks finishing the day higher as a potential government shutdown looms. For more, we want to bring in here Arneem Holzer, global macro strategist at Easterly EAB. Arneem, always great to see you, especially on set. Let's start here, Arneem, because it was a strong quarter for the markets. Let me get your thoughts just on Q3, what you saw, and now look ahead. And I'm curious to get your take on whether you think this momentum continues.
I think it's a great question. This quarter shows you how important it is to have earnings momentum. It shows you how important it is to have hope around secular themes. We had a very interesting dynamic around inflation. We had an interesting dynamic around trade policy, concerns, perturbations. But at the end of the day, this market has really taken hold of this idea that there's still upside. There's still some hockey stick around CapEx, around earnings, around growth. And despite some of the risk issues, which do look a little complacent in terms of the way the markets are looking at downside, it is all about hope around that hockey stick of growth. That doesn't necessarily mean that this continues, but I think even today's reaction with the government shutdown coming tells you that equity markets are looking at this setup as a different kind of construct, but not necessarily, a terrible one to fear.
Give me your reaction to the market's reaction to this looming government shutdown. What do you make of it? Which feels like a shrug.
It doesn't just feel like a shrug. Yeah. It is a shrug, and it's a shrug both on the fixed income side and it's a shrug on the equity side.
Are markets being too complacent in your opinion?
Well, I will say this, that when we look at the way stocks are performing, because of the drive towards some of these smaller, some of these disruptive companies, you're seeing a disconnection in correlation on the stock side. So implied correlation is down at about 10, which would imply there's no macro at all. And the reason for that is that there's a tremendous amount of equity index volatility being sold, and people are buying individual stocks. And so it really looks like people are piling into idiosyncratic risk, and they're saying, look, if I buy really good names on these secular themes, if the market goes down, some of these companies are still going to win. And so it kind of makes sense when you dig, but at the end of the day, there are risks here. And if you get not a 7-day cycle of shutdown, but you get more like a 30, 35, which we have seen in the past, there can be economic effects. I mean, there is clearly an effect to GDP if you get a month of no government workers getting paid, right? So we can't ignore that. But at this moment, the market's really more focused on what's going on in terms of growth, productivity. And as a result, they're kind of ignoring the risks here. That doesn't mean it's right, but that's what you saw today.
Let me ask about earnings, because earnings season is going to be here before we know it. Absolutely. What are your expectations? What do you think you're going to hear from CEOs and CFOs? What does corporate profit look like?
Well, it's interesting. When I was here last late spring, we discussed the idea that the corporate boardroom was going to be critical to see what CapEx really came into this AI and this productivity miracle. I think we can both agree. The boardrooms have been investing. The numbers have been staggering. And so what we think you're going to see, because of productivity and because pricing is still relatively good, remember, inflation being slightly at the higher end of target means nominal growth, and nominal is supported, which is good for earnings. So somewhere around 7 to 10% this year, maybe a little better earnings growth, means the year probably is going to be a good year. So that's not so scary. But the issue really is, as we look at the amounts of money that are being spent, the incremental dollars, are they going to have the payoff? And you're beginning to see in some of these names, for example, in some of the power names, you're beginning to see have these kind of generated to levels, PE levels, that are very heady for them. Are they going to be able to, in 26, deliver the same kind of growth? What's going to be the adjustment? I think for this quarter, there's going to be some rationalization of future expectations, but not to the degree where you're going to see a massive correction. But I do think you're going to start to see some preparation, because the amounts of CapEx that are being delivered basically mean the return of capital to investors is going to be lower, because the investment in the business is going to be higher. So far, investors have gone with it and said, Meta, this is great. You want to build out CapEx? We love it. Alibaba, you want to build out CapEx? We love it. But there does come a point in time when the PE reaches a certain level where investors start to wonder, okay, where's the return of my capital? When am I going to start seeing dividends and buybacks? There's going to be a point here in the next quarter. It might be first quarter of next year, but we have to start to see that happening, because this has been a very compressed CapEx expansion. And I do think at some point investors are going to say, okay, how do we see the payoff here?
What did you make of Jay Powell's recent comments, where our own Fed head seems to suggest we're stretched here?
Well, my 35 plus years of experience, I remember some of our Fed chairmen making comments about other industries, biotech, et cetera, et cetera.
Right.
And they're not usually great stock pickers. And it's not my job here to be a stock picker either. But I will say that valuation connotes future return. So when you're in the top quartile of valuation experience in a sector, you have to expect that the next 3 to 5 years, the returns are going to be maybe in the lower half to lower quartile of expected returns. That's not a hard and fast rule, but it's not a wrong-headed way of thinking about it. I think what the Fed chairman is saying is we have to be careful about what we assume the returns here are going to be. And unless the Fed really eases a tremendous amount, it's hard for me to see multiples expanding a lot from here.
Arnim, always great to see you, especially on set. Thank you, sir.
My pleasure.
Odds of a shutdown, Henrietta. Where are we right now? What are you telling clients?
It would take a Christmas miracle to avoid it at this point. They're just not talking. I think technically I'm in the 80 to 90% range, but that is exceedingly high for me, and I don't see a lot of forward progress here.
Henrietta, can you remind us as investors what's on the line here?
Yeah, the biggest thing for investors is obviously, as Ben just pointed out, the 8:30 Friday morning employment situation for September. And the thing that's most striking here is that this is an active choice. This is a consequence of a shutdown. The information, the BLS staffers, Department of Labor staffers have all been working all month long to compile this data. We're going to get it all the way till midnight tonight. And really, they're just not going to turn the internet on and press send on that data on Friday morning. So obviously, it's a little bit more complicated than that. But on Friday morning, this information that the agency has is not going to become public to investors. And I think given what we've seen from BLS firings over the summer and the threats towards Lisa Cook and rest of Federal Reserve boards, there's a lot of attention on the integrity of the data amongst investment professionals, certainly a topic of conversation in every meeting that I have. So as we go forward, that's going to compound, because the data that we would otherwise get reported throughout the month of October is also not going to be collected and won't be released. So that's probably the most market impacting development.
George, I want to bring you in here as well. Henrietta brings up the good reasons this should be on our radar as investors, George. But when you look at the market reaction here, honestly, George, it looks like kind of a giant yawn, and I'm curious what you make of that.
Well, I wouldn't quite say it's a giant yawn, but it is something that investors need to focus on. So building on what she had said about economic impact, I think it's important to look at what does this mean for investors and where might you be able to put your money. And if we look back to 2018, it lasted about 34 days. Not a lot of fun, especially for those who are government employees. On the other hand, this comment is really for investors. You need to separate from what you personally may feel as opposed to what you might feel in your pocketbook. So there's plenty of opportunities, because going back to 2018, the market had a decent rebound and bonds did pretty well also. So you need to look at what can I do? How does this affect me personally? And where should I be investing? Long-term strategy.
Let me ask you, George, as an investor, if there was a government shutdown, how and where, if at all, would that impact how you want to put money to work?
Sure. Well, a couple things that make sense would be to look at defensive sort of plays, items that wouldn't be affected by the government shutdown. So something like Republic Services, which is a trash hauler, which is well known. They dominate in their industries. They've got 360 different recycling centers and trash pickup centers. They're very competitive. They've got low margins. It's kind of the play that would perfectly make sense through any sort of economic crisis. I think that's the way you have to look at things.
Henrietta, if there was a shutdown, how long could that shutdown last? And what are the variables, Henrietta, that would depend on?
Yeah, that's the question of the hour. So there's a lot of rampant speculation on Capitol Hill and amongst my former peers and colleagues that I speak with. And there's a possibility that votes could happen to reopen the government as early as Friday. It wouldn't be early enough to get the employment data out at 8:30 a.m., but it comes after the Yom Kippur recess, which everybody pretty much acknowledges right now they're going to be shut down for throughout Thursday. So votes again on Friday are entirely possible. My latest discussions with House and Senate staff suggest that votes in the Senate, at least, could occur throughout the weekend, and the House will get back on Monday. So this could be a very short duration shutdown. What you want to be mindful of is the October 10th date when every other Friday, federal employees get paid. There's going to be about 750,000 people who are furloughed here, and a good chunk of them get paid every other Friday. So when members are in session and they're voting and they're going to work every day, their essential staff is doing that also, but they're working for free. And the senators and the congressmen get paid. And that's true of the military as well. All the servicemen and women are going to work unpaid, as are everybody that goes to work at an airport, making sure that we're all safe. They are not being paid. So that tends to have a psychological impact on the members as they get back to the negotiating table.
George, I'm just curious, as you've been talking to clients recently, how much is a government shutdown coming up in conversations? How much is it, on that wall of worry for clients?
Well, it's interesting. It's sort of the worry of the day, because if you look back a couple of weeks ago, it was what was the Fed going to do? Were they going to cut interest rates? Obviously, twinning with that is what's happening with the different war fronts around the world. So, yes, our clients are concerned. The good thing for us is most of our clients have good trust in us and let us make the big decisions. But yeah, that's sort of the worry for the day. And I think it's one of those things where this too shall pass. We've seen this plenty of times before. It's the only difference right now is that you've got two sides of the aisle that really have disdain for each other, and that's going to be difficult in any sort of negotiation. So what I hope will happen is that emotions can take the back seat to doing what's best for the country, and that's what we elect our collective representatives to do. So hope that'll happen, but meanwhile, there are opportunities out there. This market still has room to run.
Henrietta, I'll end here with you. If there was a shutdown, I'm curious, who do you think the American public would blame, Henrietta? Would it be, would it be Democrats? Would it be Republicans? Or could it be kind of, pox on both your houses?
Well, Republicans are going to blame Dems and Dems are going to blame Republicans. That's what the polling data suggests. The difference is really in the independent voter, which, of course, is the critical and growing group of Americans who vote in regular elections. So there's a Morning Consult poll that they just put in the field of 2,200 American voters, and it finds a 13-point gap to the benefit of Democrats, thinking that Republicans are to blame going into this one. And I think that the rationale is probably that, the president is a Republican, the senators are Republican majority, and the same is true in the House of Representatives. They're Republican as well. So when they look objectively at what's going on here, they're blaming the majority party. That's the state of affairs right now. As I mentioned before, once you actually shut down, things start to go sideways and unwind pretty rapidly. I agree with George. This is a bad look for everybody. Certainly not what I voted for. So we'll see where it goes from here. But right now, the ball is in the Democrats' court. They got 13 points to run with. We'll see how long it takes them to get rid of that goodwill.
All right, Henrietta and George, thank you both for your time today. Appreciate it.
Great.
Washington is in turmoil once again, with investors wondering how a government shutdown can affect their money. That's what we're digging into on today's Stocks in Translation. A shutdown happens when Congress misses a budget or a short-term fix. Essential services keep running, but many others pause as most federal workers are temporarily let go or furloughed. So let's break down what a government shutdown is and is not. First, it's a temporary funding lapse. It slows some services, and it can delay many data releases, like the monthly jobs report we're supposed to get this Friday. It can also delay federal permits and loan approvals. Just as important, here's what a shutdown is not. It isn't a government default on debt. Also, stocks and bond markets do not close. And essential services like law enforcement, transportation, social security payments, they keep on going. It's not the end of the world, but it can cause inconveniences. In the late 2018 shutdown that went on for a record 35 days, the SEC was unable to process paperwork, and that delayed both the Uber and Lyft IPOs by months. Now let's take a look at the actual market impact of the 11 U.S. shutdowns since they became a thing in 1980. We're going to start with stocks measuring the S&P 500. Here, each bar represents the median return for a different time period. And for the first two bars, they are the week prior and the day prior to the shutdown. And for after the shutdown, we look at the performance: 1 day, 1 week, 1 to 3 months, and 1 year following the shutdown date. And as you can see, the median returns, which are kind of like an average, they're pretty small until you get up to about a month after. We did see some pretty big reactions to the downside leading in the week of 1982, 84, and 2018, but the shorter time frames do not produce clear trends. But even in 2018, when the government shutdown went on for over a month, stocks were positive after a short initial drop. Translation: markets tend to look past the noise once the funding headlines fade. Now let's take a look at the long end of the yield curve, the U.S. 10-year Treasury note yield, which mortgages across America are tied to. Much like stocks, when you put all the results together and take the median, we don't see big changes in the week prior to the week after the shutdown. We did, however, see some big outliers in many years. So it's not like bond yields didn't react the week prior and after. There's just not a predictable historical pattern over the entire set. But once you start looking 1, 2, 3 months after the drop, you see consistent drops in long-term yields. In 9 out of 11 times, rates dropped 1 month after the shutdown started, with a median drop of 19 basis points, or about 0.2%. Finally, we also took a look at short-term movements in U.S. rates, which admittedly tend to move around Federal Reserve policy more than anything else. Once again, we see lots of big and small moves, both to the upside and the downside, from 1 week prior to 3 months after, which don't really produce any big trends. However, 1 year later, we do see some drops in short-term rates about 2/3 of the time, with a median drop of 39 basis points. Here's the roll-up. Stocks tend to be flat around the start of shutdowns. Then they climb higher 1 to 3 months out. But remember that stocks also tend to go up, so that's a big tailwind. For bonds, long-term yields tend to drift lower over 1 to 3 months, and short-term rates are mixed until they skew lower at about the 1 year mark. And here's what to keep an eye on. First, the continuing resolution path. That is a quick off-ramp to avoid or end a shutdown. 2, length matters. The longer the standoff, the more it can nick growth expectations and pull long-term rates even lower. 3, data delays. If reports slip, markets lean harder on data that's not coming from Uncle Sam. And finally, we do see spillover effects as federal contracts, small business loans, and travel and park areas, they can all feel the stoppage. Wrapping it up, shutdowns are politics loud and markets quiet unless they last. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.